Hi everyone, and welcome to the Buffett and Beyond Research Saturday Market Recap Letter, and this is Saturday, December 9th, 2023. Remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this week, well, the market, we finished the week pretty much where we ended last week, and this is very promising because the momentum indicators are pointing down. But interest rates are also heading down, and lower interest rates are putting a floor under this market for now. So let's see what's going to happen this coming week, folks. But we are in the holiday season. Everybody is joyous. And our weekly stock analysis video, well, Google, our old friend Google. Google's earnings are not only going up, but they are heading up at an accelerating rate. Now, their interest in AI, artificial intelligence, is certainly helping the stock, but it's not hype that's sending the stock up. It is beating earnings expectations, and that's what's propelling the stock upward over the longer term and up about 55% this year alone. Now, our ETF video, well, we had to pick on Forbes, because Forbes picked ETFs, the best ETFs for 2023, and we compared their ETF picks against our ETF picks, and folks, Forbes was out of the game after the first inning, believe me. What is even better is that our best stocks in each ETF, as configured by Clean Surplus Return on Equity, when averaged together, returned 286% on a compounded basis over the past 5 years. Now, folks, that's something to talk about, so let's get right into it. And don't forget to watch the ETF video, because then you'll see exactly what we're talking about. And when we look at the market, well, here we are. The red lines are the volatility bands, and you see they're coming closer and closer. And that usually means there's going to be a market move one way or another. Like back in here, you see when they came close, all of a sudden the market shot down. Now, over here, way back over here, when they came closer together, the market went down. So we're looking for something to happen in here, and we can see that the 20-day moving average, this center line, is moving up to meet the market because the market is not doing anything. In fact, it is still toying with this 4,600 level. And in fact, the S&P 500 closed at 4,604. So finally, it closed above the 4,600 level. And that's a pretty nice indication. We like to see that. Now, down here, the intermediate term indicator is pretty much flattened here, pointing down a little bit if you want to just kind of eyeball it in here, because the blue line does seem to have crossed below the red line, but not significantly. So we kind of call this flatten here. Now, let's go to the Dow, and we can see the Dow had that big run up last week, and we ended right up here, right at this point. And now 1, 2, 3, 4, 5 days of doing nothing. And folks, if this market turns down next week, right in here, we might get a bearish divergence. But this is very, very short term, so we just have to see what's going to happen next week. We have the 50-day moving average turning up. This is this blue line here. We have the 200-day moving average moving slightly up. This is this red line in here. However, down here, the intermediate term indicator is starting to roll over. So we're looking at that. And this market wants to correct, but interest rates have been dropping this past week, and that's what's putting a floor under this market. It's hard to beat falling interest rates, believe me, and the market knows that, and yet the indicators are topping out and getting ready to roll over, but boy, this market just won't give in. And when we look at the S&P 500, we're kind of seeing the same type of thing in here, except down here, this black line did cross over the red line, and now it's flattening out, just like the Dow did a few slides ago. So we're looking at, or last slide, so we're looking at the same type of indicator here, is that this market doesn't want to break. And now when we look at the QQQs, which are the NASDAQ 100 stocks, we actually got a little buy in here. Very, very short-term buy. And yes, it actually worked. And so this market is going up, but it has not surpassed this high over here of the last couple of sometime last week. And it looks like this wants to turn over and come back down, and that would give us the bearish divergence. Very, very short time. But down here, the intermediate term indicator is still pointing down. This black line seems to be flattening out, but maybe we're making a mountain out of a molehill, and we'll just have to wait to see what this market does, folks, because guess what? We're getting toward Christmas. It's Hanukkah. Well, a lot of things have gone on this week, so we'll see what happens this coming week. People are in a festive holiday mood, so it's hard to beat falling interest rates and a festive holiday mood, and the market indicators pointing down. This market just doesn't want to break, but sooner or later we'll get a little correction, and then we just might be off again heading into next year, because the word out is the European Central Bank said they are going to lower rates in 2024, and now our economists are saying the same thing. Maybe not the first quarter, but going into the second quarter, because they see a slight recession, but a soft landing. And if we go anywhere near a recession during an election year, the Fed might be seen as favoring the outgoing party or the ingoing party. You know, there's all that political stuff there. But the Fed will come to the rescue of the market as soon as they see or sniff a recession in there. And don't forget, we have this gap that's going to be filled sooner or later. So, and don't forget, there's another gap down here too. But we want to see maybe this being filled. And you can see the market came right down to the beginning of that gap this past week. Actually, it was on Monday. And, well, we'll just have to see what happens this coming week. But everybody's happy, and so not dire consequences on the market as of yet. So we'll just see. We don't expect a big correction if there is one, because interest rates are coming down. And for those of you who have portfolio protection on all the time with the puts, we have the SPY, and remember the SPY is 1/10 of the S&P 500. This is about a $135,000 portfolio, and so we have 3 puts, and we like to space them out so we don't get caught with them expiring all at one time, and then we have to roll over. And anytime you have to roll over, guess what happens? It's always expensive. It's like hurricanes coming, and you have to have hurricane insurance, and you don't have it, it's going to cost you if you can get it. So that's why we go out 3 months in a $135,000 portfolio, so they don't all expire all at once. We just keep rolling over, and it's very inexpensive now, so it's a good time to have portfolio protection. And when it comes to our indicators and the short term on the QQQs, we got that little buy signal in there that lasted a day or two. It might last into next week. The intermediate term on the Dow is still pointing up, and so we have 2 ups, one on the short term on the QQQs, one on the longer term, the Dow. But this is starting to roll over. We pointed that out. That black line is starting to roll over, and we'll see how long this up signal lasts. And it's all going to come to fruition this week. So we'll take a look. Hedge timing, yeah, we're still hedged on the tech ETF, on the QQQs, and on the semiconductor ETF. They're all kind of in limbo there. So just keep those hedges on, because they're not hurting us. They're not going up, they're not going down, and so we're just sitting there just like the rest of the market. But if the market should drop all of a sudden, we are nice and hedged in here on the tech, the semiconductors, and the QQQs, which are mostly techs. And those of you who always have your hedges on, well, you have your hedges on. That's why that on is always there, and that's in the ETFs. So, folks, yeah, we've had a good week, and the market has not broken at all. Interest rates, the lowering of interest rates, keeping this market up. Holiday season, keeping this market up. So if you want to live on this beach like Jimmy Buffett once did at sunrise, then you want to be able to invest even better than Warren Buffett does at sunrise or in the afternoon or noontime. Whenever Buffett invests, you want to be better than him. And yes, our portfolios outperform Buffett's portfolios, which outperform the S&P 500. And remember, 96% of professional money managers cannot outperform the S&P 500 over any 10-year period. So we are one of those few out there that do that. All right, folks, you have a good weekend. Stay safe. be with your family, be with your loved ones, and guess what? The market will be open back on Monday. We'll see you then.